I want to start off today by asking you a question. It's a question that is currently keeping thousands of retail investors pacing the floor at night.
Oh, absolutely.
Right, because here it is. Is Rivian, which is trading right now at exactly $17.15, on the verge of a massive, explosive breakout? Or are eager retail traders walking completely blindfolded into a beautifully designed value trap?
Yeah, that really is the multi-billion-dollar question right
It
now.
is.
And you can feel the tension. It's palpable. Because when you look at the raw data we have in front of us today, you can make a startlingly compelling case for both scenarios. I mean, it's wild.
Okay, let's unpack this. Welcome to today's deep dive. Today is April 22nd, 2026. Rivian Automotive, ticker symbol RIVN, is currently riding this, honestly, incredibly aggressive, short-term bullish wave.
Yeah, a massive wave.
And our mission today is to look completely under the hood for you. We've compiled a massive stack of sources: the latest quarterly and annual financials, the technical charts, the underlying order flow, and a frankly chaotic divide in Wall Street analyst ratings.
Chaotic is the perfect word for it.
Right, because we want to figure out if this stock is actually a strong buy or if you are just looking at a dangerous illusion. And hey, quick reminder, if you're getting value out of this, please like the video and subscribe to our YouTube channel.
Yes, please do.
And honestly, leaving a comment with your feedback is practically compulsory for true learners. We want to hear from you.
Definitely. And, it is so critical to strip away the emotion here. Electric vehicle stocks are deeply notorious for generating this, tribal hype.
Oh, 100%. It becomes a religion for some people.
Exactly. So we have to look at the cold, hard mechanics of the business. And to understand anything about Rivian's stock price right now, you really have to understand the context of the specific year we are in. Industry insiders are universally calling 2026 Rivian's bridge year.
A bridge year, meaning they are trying to cross from one distinct phase of their business to another.
Precisely. I mean, they're trying to get from being a niche manufacturer of these $80,000 luxury trucks to a true mass market auto manufacturer.
Right, with the new models.
Right. And right now, the entire market is hyper-fixated on two things to see if that bridge holds. First, the upcoming Q1 earnings call, which is just days away on April 30th.
Coming up real quick.
Yeah. And second, the highly anticipated launch of their mass market vehicle, the R2. Every tiny movement in the stock price right now is basically a psychological reaction to that bridge.
Yeah, and to understand the stakes of this transition, we first need to look at exactly how the stock is behaving today, because I'm looking at the recent price action, and in the short term, it looks like a rocket.
Oh, yeah.
It's up over 1% today, but more importantly, it is up a very solid 15% over the last month alone.
Yeah, but then, and this is where it gets tricky, when I zoom out and look at the whole year, the picture completely changes.
It really does. It's a totally different story.
Yeah, the trend flattens out, almost bordering on bearish. What is the actual range we're dealing with here? Well, if you look at the 52-week range, the absolute floor, the lowest it's been in the last year, was $10.85. And the ceiling, the absolute peak, was $22.69.
Wait, so at $17.15 today,
Yep.
we are floating exactly in the dead center of that range, like perfectly in the middle.
Exactly. And what's fascinating here is what that specific positioning does to the psychology of the market. Trading in the exact middle of an annual range creates an absolute battleground for investors.
Because everyone is seeing a different story. I mean, look at it this way. The momentum traders are looking at the recent 15% climb. They're feeling the FOMO, thinking we're breaking out. I need to get in before the April 30th earnings call.
Right. They see the short-term velocity.
Exactly. And on the other side, the institutional bears are looking at the historical resistance, thinking, well, it's bumping its head on the ceiling. This is where the rally runs out of gas. It's like a car stuck in second gear, revving super high right now, but barely halfway down the track when you look at the big picture.
That's a great analogy. It's pure tension. It is a coiled spring. Momentum traders are betting on velocity, while historical traders are just, betting on gravity.
So we have a stock caught in a literal tug of war. Let's see if the company actually has the fundamental financial fuel to break out of this range.
Let's do it.
So pulling up the income statement for the full fiscal year of 2025, I see that total revenue hit $5.387 billion, which, the sources note, is an 8% year-over-year increase. But honestly,
Yeah.
8% growth doesn't exactly scream hyper growth tech company to me.
No, it doesn't, but you really have to contextualize it. The overall EV market faced massive, massive demand headwinds globally in 2025.
Right, with the interest rates and everything.
Exactly. Consumers were completely squeezed by interest rates. In an environment where some legacy automakers actually saw their EV sales shrink, fighting your way to 8% top-line growth means they're still capturing market share. Even if the overall pie isn't growing as fast as people predicted, say, 3 years ago.
Fair enough. I mean, growth is growth. But let's look at the bottom line, because this is where my alarm bells really start ringing.
A cash burn.
Yeah, the net income for the year was a massive loss. Negative $3.646 billion.
It's a huge number.
Basic earnings per share sits at negative $3.07. Now, the analysts point out that this loss actually narrowed from 2024. But I have to push back here. They lost $3.6 billion in a single year.
Yeah.
If we look at free cash flow, they are deep in the red at negative $2.49 billion. How is this company not going bankrupt? I mean, it feels like the burn rate of a startup trying to lay down train tracks right in front of a moving train. How long until the train just derails?
That is the exact right analogy, and I agree it's a staggering amount of cash to burn. But if we connect this to the bigger picture, you have to realize that building a car company from scratch is arguably the most capital-intensive legal business on earth.
Right, you're not just writing software.
Exactly. You are building massive physical factories, buying robots, establishing global supply chains. To see if they can survive that burn rate, we have to look at the balance sheet. They currently have a cash runway of roughly $6.08 billion in cash and short-term investments.
Okay, wait, so they have about $6 billion in the bank, but they burned $2.5 billion in free cash flow last year. That means they have maybe 2.5 years of runway left? That's entirely too close for comfort.
It is tight, and that is exactly why Wall Street isn't looking at free cash flow as the ultimate measure right now. They're looking at operating cash flow, and this is critical.
Great.
Rivian's operating cash flow actually improved by nearly $1 billion. It went from negative $1.7 billion to negative $779 million.
Okay, explain that mechanism for me. Why does $1 billion improvement in operating cash flow matter more than the overall free cash flow loss? Because to the average person, a loss is a loss.
That's a great point. It matters because it proves the core business is actually working. See, free cash flow includes all the money they're spending on building new factories for the future, the capital expenditures.
So the new plants, the expansions.
Right. That's a choice. They are choosing to spend that money to grow. Operating cash flow, on the other hand, just measures the money going in and out from actually building and selling the cars they make today.
Oh, I see.
So by improving that number by $1 billion, they are proving they have squeezed out inefficiencies. They renegotiated supplier contracts, they optimized the assembly lines, they proved that as they scale up, they lose less money per car. If that number was getting worse, the company would be dead.
So the fact that it's getting dramatically better tells us the tourniquet is working.
Exactly.
Got it. So the fundamentals show a company that is bleeding heavily to build its future, but the core business of, bending metal and selling trucks is actually getting vastly more efficient. They have this $6 billion to get across this bridge here. But if that's the long-term reality, let's pivot to the technical charts and the order flow to see how traders are playing this right now. Because I'm looking at the technical indicators, and they are flashing green absolutely everywhere.
Oh, the technicals are definitely creating a highly seductive setup for retail investors right now.
Seductive is a good word for it. According to the charts, the stock is currently trading above its 50-day moving average, which sits at 15.51. It's also above its 200-day moving average, which is at 15.14.
Right.
So the short-term price has crossed aggressively above the long-term baseline. Literally every basic charting algorithm out there is currently flagging Rivian as a strong buy.
Yeah, they are. And what are you seeing on the momentum side? Because that's where the nuance is.
Right, so the momentum indicators are positive, but this is exactly where I get incredibly skeptical. And looking at the relative strength index, the RSI, depending on the chart provider, it's reading between 61 and 75.9. For anyone listening who isn't a day trader, what does that RSI number actually tell us about the psychology of the people buying this stock today?
So, the RSI is essentially a thermometer for market enthusiasm. When a stock's price shoots up really fast, the RSI climbs. Once it crosses over 70, it enters what we call overbought territory.
Meaning everyone has already bought in.
Exactly. It means the buying frenzy has been so intense and so one-sided that the price might be artificially inflated past its near-term value. The buyers might simply be exhausted. There's no one left to push it higher.
which is terrifying when you look at where the price is sitting right now. The charts show a primary wall of historical resistance sitting right between 17.23 and 17.5. We are at 17.15 today.
We're right there.
We are literally pennies away from hitting a historic ceiling, exactly at the moment the RSI thermometer says buyers are completely exhausted.
The momentum is peaking right as the stock runs into a brick wall. That is the classic textbook definition of a short-term pullback risk.
And to make matters worse, I'm looking at the insider trading data. The CEO, Robert Scaringe, sold over $1.79 million worth of shares in April 2026 alone.
Yeah, that made some headlines.
So I have to ask you directly, is this a setup? I mean, are regular folks opening their brokerage apps, seeing these moving averages flashing strong buy, and buying in right at the exact moment the CEO is quietly dumping his shares before it hits the resistance wall?
I mean, that is exactly what it looks like on the surface, and it's a completely natural fear for an investor to have. But we need to translate what that insider selling actually is, because a lot of financial news heavily sensationalizes this stuff.
Okay, so what's the real story?
The filings show the CEO sale was executed under a 10b5-1 program.
Which is a legally pre-scheduled stock sale, right?
Exactly right. Executives set these automated selling plans up months or even sometimes years in advance.
Yeah.
The goal is specifically to avoid accusations of insider trading based on current events. It means he didn't just wake up last week, look at the overbought RSI thermometer, and hit the panic button to dump his shares.
So it's routine corporate housekeeping.
Totally routine.
Okay, well, that's a relief. So the CEO isn't running for the exits. But even without the insider panic, the technical setup, hitting resistance while overbought, is still incredibly dangerous, especially when you factor in the short sellers.
Oh, the short sellers are a massive factor here.
Right. The short interest right now is sitting at 11.8% of the float. That is over 142 million shares sold short. There's a massive segment of the market actively betting this stock is going to fail at that resistance line and drop.
Yes, 11.8% is a heavy, I'd say moderate to high bearish bet. But there is a secondary metric attached to that short interest that changes the game entirely, and that is the days to cover ratio. The sources have it at 4.86 days.
Explain the mechanics of that. Why does days to cover matter to someone holding the stock?
Well, when you short a stock, you borrow shares and sell them, hoping to buy them back later at a cheaper price.
Right.
But eventually, you have to buy them back. The days to cover ratio calculates how long it would take for every single short seller to buy back their shares based on the average daily trading volume. So at 4.86 days, it would take nearly a full business week of constant buying to close all those negative bets.
So if Rivian drops a massive positive surprise on their April 30th earnings call,
then all those short sellers instantly start losing money.
wow.
Yeah, they panic and they all rush the exit at the exact same time, trying to buy back 142 million shares. But there aren't enough shares trading hands in a single day to satisfy them, so they have to bid the price up and up and up. That is exactly how a short squeeze happens. It acts like a rocket fuel on an already bullish trend.
So the retail trader is genuinely caught in a trap here. On one side, you have a brutal rejection at the $17.50 resistance line. On the other side, a potential short squeeze that could send the stock into orbit. And that exact technical tension, the threat of a massive squeeze versus a brick wall resistance, seems to be driving Wall Street completely crazy because it has caused a total breakdown in consensus among the analysts.
Breakdown is an understatement. I mean, the professional analysts are looking at the exact same charts and the exact same balance sheet we are, and they're living in completely different universes.
Let's look at the numbers. The general consensus rating is listed as a hold to a moderate buy, but the median price target is $15.93.
Right.
That means the median Wall Street analyst believes the stock is going to drop from its current price of 17.15. But here's where it gets really interesting. You look at the extremes. JP Morgan has a target of $10. They think it's going to crash. Meanwhile, Tigers Financial sees it rocketing to $25.
And the valuation models are even more deeply divided. It's crazy.
Right. Because Simply Walcent ran a discounted cash flow model, a fundamental calculation of the business's intrinsic value, and they claim the stock is 61% undervalued.
Yeah.
They gave it a fair value of $40.92.
Yeah.
But conversely, 247 Walcent projects a drop to $14.57 due to EV market headwinds. I have to ask you, how is this even possible? How can two groups of highly paid financial experts run the math on the same company, and one says it's worth $40 and the other says it's worth $10?
Well, if we connect this to the bigger picture, it's actually a philosophical divide about how to value an electric vehicle company in 2026.
Hmm.
The analysts aren't disagreeing on the math itself, they're disagreeing on the timeline.
Oh, interesting.
Yeah. A discounted cash flow model works by projecting a company's future cash flows and discounting them back to today's value. The firm giving Rivian a $40 target is basing their math on 2030 projections.
Ah, so they are pricing in the destination, not the journey.
Exactly. They are valuing Rivian like a high-growth software and tech startup. They are assuming Rivian successfully crosses the bridge, that the mass-market R2 vehicle is a runaway hit, that they scale to hundreds of thousands of vehicles and achieve massive tech-like profit margins by the end of the decade.
Okay, and the firm's putting a $10 or $14 target on it. What are they looking at?
They are valuing Rivian like a traditional legacy middle bender. They aren't looking at 2030. They're looking at the mud on the bridge right now in 2026.
The actual reality on the ground.
Right. They see the reality of slowing EV demand, they see the heavy cash burn, and they see the massive execution risk of trying to scale a physical supply chain. They are pricing in the very real possibility that Rivian stumbles before the R2 ever reaches mass production.
So to figure out which camp is right, the $40 tech optimists or the $10 manufacturing pessimists,
Right.
we have to weigh the specific catalyst that will drive this company over the next 12 months.
Exactly.
Let's outline the bull case, the bear case, and the real-world risks.
Sure. Let's start with the bulls. The absolute biggest weapon in Rivian's arsenal right now, the thing that provides that $6 billion liquidity cushion we talked about, is their massive joint venture with Volkswagen.
Right. The sources say it's a $5.8 billion partnership.
Yeah.
How does that practically change the game for Rivian?
It completely alters their survival timeline. Volkswagen isn't just handing them cash. They are partnering on electrical architecture and software.
So they're sharing the tech burden.
Exactly. For Rivian, it acts as a massive validation of their technology from one of the largest legacy automakers on the planet. It lowers their independent R&D costs and injects billions in capital exactly when they need it to build the R2 factories.
It's the ultimate lifeline. And the bulls also point to the fact that Rivian has achieved positive gross profit in consecutive quarters, meaning, before you factor in the massive corporate overhead and R&D, they are finally making a physical profit on the actual vehicles rolling off the assembly line.
Which is huge for an EV startup.
Yeah. Plus, the prototype testing and pre-order momentum for the upcoming R2 platform have been incredibly strong.
They have. But the bear case is just as potent, and it is entirely focused on execution risk. First, you have severe physical production risks. The sources explicitly highlight recent tornado damage to Rivian's factory in Illinois.
Which isn't just a minor headline. I imagine when a roof gets ripped off a factory, you don't just lose the cars sitting inside, you lose the entire rhythm of the operation.
Oh, absolutely. The supply chain backs up. Parts just sit on loading docks. Workers are idled. You are burning through millions in fixed costs while producing zero revenue. It is a severe threat to their near-term delivery targets. And then add to that the ongoing cash burn from constructing their brand new plant in Georgia.
And then there are the macroeconomic headwinds. Material costs are remaining stubbornly high, which is squeezing margins across the entire auto industry.
Yep.
And there is the looming threat regarding federal EV tax credits. Now, to be incredibly clear to you listening, we are not looking at the politics of tax credits here.
No, not at all.
We are strictly looking at the stated financial risk to the company's bottom line. But from a purely economic standpoint, if a government subsidy that artificially lowers the purchase price of your vehicle by thousands of dollars suddenly vanishes, that is a massive, immediate headwind for consumer demand.
Right. And this raises an important question about the reality of manufacturing. The bull case relies on absolutely perfect execution.
Which rarely happens.
Exactly. But the bear case points out that all the Volkswagen cash in the world doesn't matter if factory damage from a tornado, spiking raw material costs, and vanishing tax credits prevent you from actually getting the cars off the assembly line at a profitable scale.
It's like trying to build a skyscraper during an earthquake.
Yeah.
I mean, the Volkswagen cash and the hype for the R2, that's the steel and the concrete. You have plenty of materials.
Yeah.
But the factory damage, the cash burn, the macroeconomic shifts, that's the ground shaking underneath you. And the earthquake is threatening to collapse the foundation before the building is ever finished.
That is a perfect way to visualize it. And right now, retail investors are buying shares at $17, betting that the ground is going to stop shaking.
So bringing all of this together, the technicals flashing a dangerous mix of momentum and exhaustion. The financials showing a massive cash burn offset by improving efficiency. and the analyst targets spanning a crazy chasm from $10 to $40.
Quite the mix.
So what does this all mean for you, the listener? Let's bring this to a final verdict.
Well, in the immediate short term, meaning in the next couple weeks, you should expect extreme volatility. We are leading right into the April 30th earnings call.
Right.
The entire market is holding its breath to see if Rivian can beat the estimated earnings per share loss of 59 cents. If they beat that estimate and give reassuring guidance that the Illinois factory repairs are on schedule, we could very well see that short squeeze trigger breaking right through that $17 resistance.
But on the flip side, if they miss the earnings estimate or announce prolonged production delays because of the tornado, that $17.23 resistance line is going to look like an impenetrable brick wall, and the bears will just take total control.
Exactly. And looking at the long term, everything hinges on this 2026 bridge year. The R2 launch absolutely has to hit its target mass market price point of $45,000. If they can manufacture it profitably at that price, well, maybe that $40 valuation for 2030 isn't so crazy.
Rivian right now is the ultimate high-risk, high-reward play. It is perfectly balanced on a nice edge between incredible tech and liquidity on one side and brutal, unforgiving manufacturing realities on the other.
It is the absolute definition of a speculative investment.
Before we wrap up, just a quick reminder, if you found this deep dive valuable, please hit the like button and subscribe to our YouTube channel. And honestly, leaving a comment with your feedback below. We consider that practically compulsory for true learners. We really want to know your take. Are you buying the bridge, or are you waiting safely on the sidelines?
And I'll leave you with this final provocative thought. We've established that Rivian has a $6 billion cash runway. We know they have enough money in the bank to mathematically survive this bridge year.
Right.
But in the global automotive industry, mere survival is not the same as market dominance. As we wait for the opening bell on April 30th to hear those earnings numbers, the ultimate question isn't whether the R2 will be a great car. We already know Rivian builds great cars. And jumping in today, just because a chart flashed a strong buy signal, actually have the psychological patience to hold on through the earthquake? Or is the violent turbulence of this bridge year going to shake them out right before the foundation sets?
A beautifully designed trap, or the launch pad of the decade. I guess we'll find out together on the 30th. Keep your eyes on the charts, and we'll see you on the next deep dive.